Ticker symbol KO has remained flat over the past year, rising only about 0.05%. However, today we'll be looking at a company that has increased their dividend every single year for the past 61 years, and why TipRanks has actually rated this stock a 10 for outperformed based on increased hedge fund trends, bullish blogger sentiments, and a moderate buy analyst consensus. So today we'll be looking at the Coca Cola Company, a beverage company that we all know. In their annual report, they define themselves as a total beverage company with beverage products bearing their trademarks sold in more than 200 countries. They have a network of independent bottling partners, distributors, retailers, wholesalers, and even their own distribution operations in order to get all their products to their final clients. Now they have 3 different segments for their products, the first one being their sparkling soft drinks, which includes the brands we all know such as Coca Cola, Fanta, Sprites, and many others. Next, they have the water, sports, coffee, and tea segment, where they sell drinks such as Aquarius. Then they have Costa Coffee, Powerade, and many others. And finally, they have the juice, value-added dairy, and plant-based beverages, where they have brands such as Del Valle, Innocent, Minute Maid, and many others. So they have some of the most recognizable non-alcoholic drinks in the whole world. And at times they even say that they acquire bottling operations, often in underperforming markets, so that they can turn them around, get them back functioning, and then periodically sell them to an independent bottler. Why do they do this? Well, because they want to keep themselves being asset light in order to increase their return on capital employed and maximize every single dollar of return they will get on every single dollar that they invest. So this is genius management operations. Now, looking at their financial analysis, they have a very good return on capital employed of 12%. However, in this channel, we usually look for companies which have a return on capital employed of 15% or even higher. However, a 12% for such a stable, value-generating company like Coca-Cola is acceptable. They have an interest coverage ratio of 7.6. Now, again, in this channel, we usually look for this ratio to be above 10. However, with the consistent of the earnings of this company, this is still classifies as them having a solid interest coverage ratio. Their cash conversion ratio is incredible at 99%, meaning that 99% of their net income is converted into free cash flow, with a profit margin of 60% and an operating margin of 26%. Great numbers for a beverage company. Now, the main red flag that people argue about Coca-Cola is that they cannot grow, that they're already everywhere, and that there is no way for them to actually increase their revenues, since everyone in the world already knows what a Coca-Cola is, and almost everyone drinks it on a weekly basis. However, in the past year, their net income has still managed to grow by 12%, double digits, and they obtained this 12% growth just by growing their revenue by 6% year over year, meaning that they're actually making their operations a lot more efficient in order to convert a lot more of the revenues into net income and expand their margins. Now, when looking at their financial position, this is a company that does operate with leverage to attempt to grow at a faster rate. However, they are in a pretty safe position as their total assets are 39% greater than their total liabilities. Additionally, we can see that in the past years there is a trend of their debt actually decreasing and their equity increasing, improving their debt to equity ratio, something that us as investors should be pushing for. Now, when looking at their efficiency ratios, you cannot get efficiency ratios as consistent as this company anywhere else, with a return on invested capital which is comfortably sitting at above 20% and has been doing so for a pretty long time. Now, when looking at the fundamental analysis for this company, they get an extremely solid 6 out of 8 ticks, starting with a low liability risk, as we have seen with their interest coverage ratio and the consistency of their revenues. Then they have a very solid balance sheet as they're able to cover all their current liabilities with their short-term assets. Additionally, they provide extremely consistent cash flows and they pay a very solid dividend, which they have been increasing for 61 consistent years. Additionally, they also offer share buybacks from time to time. Next, this company of course has pricing power as their brand is one of the most powerful brands in the world. You just see their drink and you don't care very much about the price. You know you prefer Coca-Cola over all the other alternatives. This goes linked with their existing moat and competitive advantage. They have such a wide range of agreements with bottling partners, distributors, and even retailers that a lot of companies are only allowed to sell Coca Cola and not allowed to sell other of their competitors, such as Pepsi, for example. This to me classifies as a huge competitive advantage, but their main moat, I would say, is their brand. They have invested so much money into advertisings and sponsoring all type of events that right now when you think of Coca-Cola, immediately you think of all their advertisings surrounding happiness and good times with good people. So whenever you're ordering a drink, you already know that you want a Coca-Cola and you expect any type of restaurant you go into to actually have this drink. Additionally, their consistency all around the world, meaning that their product is more or less priced around the same ranges and tastes exactly the same all around the world, is something that has driven customer expectations and allowed us to actually enjoy this product so much. However, the two main things that I'm actually lacking from this company is, of course, their organic free cash flow growth, which is not taking place due to them not being able to organically grow their revenues. Now, this is based on what we said at the beginning, that they have grown so much and they're already present in over 200 countries that there is little room for growth in their operations. Now, when looking at their dividend, they have an extremely solid and consistent dividend, which is right now trading at a dividend yield of 3.02%. Now, there is something a bit worrying, which is that their payout ratio is 75%. This is pretty high, as this is the amount of free cash flow or the amount of net income that they're actually paying in dividends, meaning that this company only has about 25% remaining in order to finance their operations, invest, or even acquire different companies. However, we can see that they have been growing their dividends every single quarter, and we can see that their dividends per share are growing at a faster rate than their amount paid, implying that they're actually conducting very recurring share buyback programs. In terms of valuation analysis, this company is trading right around where it has been trading for the past 4 years, and the fact is that this company's price does not vary too much. Investors buy it mainly for the consistent dividend and the consistent dividend increases. But when we're looking at the free cash flow yield of 3.66%, this is actually higher than the long-term inflation rate of 3%, implying that this company is trading at a pretty attractive valuation at the current moment. Now, some risks and possible challenges I do see for this company is, first of all, the worsening competitive landscape, where I wouldn't be worried about this, since their existing competitive advantage will keep competitors away and will not change customer preferences from one day to the other. However, they do have to be aware with their other brands like Minute Maid, Innocent, or even Costa Coffee, where those don't have the established brands yet that Coca-Cola has. They do have brand power, but not as much, and they do have to be aware of the worsening competitive landscape in those areas. Now, in terms of possible regulation changes, I do see this as the major risk, as there is a trend of removing sugar and all types of non-healthy drinks away from the market, or at least putting like age restrictions. For example, I know close to where I live, they have put regulations where anyone under the age of 18 cannot actually buy energy drinks because they're bad for your health. So this would be kind of a worry for me. However, since they're investing a lot on their healthy drinks, I believe that they're actually gearing towards the right direction. Now, in terms of performance objectives, I don't see this being a risk, and I don't think that Coca-Cola and drinks consumption will actually be affected by an economic downturn. Now, before moving on to the investment conclusion, please remember that I'm not a financial advisor, and this is not financial advice, so please do your own due diligence. However, I believe that Coca-Cola has a huge moat and a very strong competitive advantage, that it provides consistent, predictable cash flows with a very good dividend on top, and they have an adequate return on capital employed where they are creating value for the investor. So I believe that is a good company and it will very likely be a great investment. However, their growth being stagnant is something that is pushing me away from this company, as I'm looking for cash flow compounders. So thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.